Okay, today you're going to continue looking at the topic of monopoly, and the specific concept is called price discrimination. So in addition to understanding what price discrimination is, you want to be able to assess the difference between a single price monopoly and a price discriminating monopoly. Now before we launch into anything new today though, I want you to take just a moment to practice the graph that you already know related to a single price monopoly. So take a look at the information on the screen, pause the video, and try to draw this graph. Alright, the slide asks for a monopoly earning a profit, so you should draw a downward sloping demand curve along with your downward sloping marginal revenue curve below your demand curve for reasons that we discussed in a previous lesson, and the quantity of the monopoly should be indicated where marginal cost equals marginal revenue. After finding the quantity of the monopoly, you want to go up to the demand curve and over to the vertical axis to find the monopoly's price, and then at that same quantity, the distance between the price and the average total cost would be the area of the monopoly's profit, which is shaded in green on the slide you see now. Now for your area of consumer surplus, as always, it is the area between the demand curve and the price. So you look at the distance between the price of the monopoly and the demand curve, and you'll see the label consumer surplus. However, I just realized that I forgot to add the deadweight loss to the graph, so let me add that in here. Alright, there we go. There's your deadweight loss triangle. Looks like an arrow pointing towards the free market equilibrium point. Base of the triangle is at the current monopoly's quantity, and that tip of that arrow would be pointing to the point where marginal cost crosses the demand curve, or where supply would meet demand, which again is the free market quantity. Okay, let's do one more bit of practice here before we get to price discrimination. So take a look at the question on the slide here and pause the video. Okay, to answer this question, you have to go back to our original discussion about why the demand curve and marginal revenue curve are not the same. So recall that there is a quantity effect and a price effect happening when the monopoly would try to sell more diamonds in this example. So to sell more diamonds, the price would have to decrease, which would increase the quantity that they're able to sell. So when the monopoly increases the amount of diamonds being purchased, that's a quantity effect, and that would increase the revenue. But at the same time, they have to lower the price in order to do that, which decreases revenue. And recall the rules of elasticity and total revenue. If the price is decreasing and the revenue is increasing, that means the demand is relatively elastic. However, if the price is decreasing and the total revenue is also decreasing, then demand is inelastic. Okay, so here is your total revenue curve, and that's the graph that appears on the bottom. You don't have to necessarily draw the demand and marginal revenue curve graph above it. The total revenue curve looks like that old school, old-fashioned McDonald's arch, and you can see that on the vertical axis you have your total revenue. On the horizontal axis you have your quantity. In order to keep selling a greater and greater quantity, the price would have to continuously go lower. So as the price is going lower to sell a greater quantity, initially total revenue increases, and that suggests that the demand in this output range is elastic. However, once it hits that peak at the top of the arch there, and the price continues to drop to sell more and more quantity, the total revenue starts to decrease, which means the demand is now inelastic. Now I want you to also take notice that the top of the total revenue curve, the top of that arch, or the maximum revenue, is where the marginal revenue is equal to 0. If you look on the graph above it, the top of that arch, or the point of maximum revenue, is where marginal revenue is 0. Alright, on to the topic of the day, that's price discrimination. And price discrimination is the selling of the same good at different prices to different customers. In other words, different customers pay a different price for the same good or service being sold by the firm. Well, here are some common price discrimination examples. You see the text caption in the top of the screen there, or the screenshot of Dutch Wonderland's pricing. You can see that depending on the age, Dutch Wonderland might charge a different admission fee. So people who are in an older age bracket or in a younger age bracket, they're going to pay a little bit less for the price of admission. Same thing with the image and to the bottom of that text box to the left, you have the Senior Citizen Day. Every Wednesday at that particular location, they're going to get 50% off. Another example of price discrimination. And another common way that stores can charge different customers different prices would be through the use of coupons. And coupons are going to be used by customers that tend to have a higher elasticity of demand. Their demand is relatively elastic versus someone who doesn't really care that much about the price. They're just going to go in there and buy whatever's on the shelf at whatever price is being charged. They're not going to use the coupons. Another example that a lot of you can relate to is college tuition. The FAFSA form there on the bottom left illustrates the idea that not everyone pays the same amount of tuition to go to school. Some people get a full ride, some people get a big scholarship package, some people are paying the full tuition fee. And the image next to that one of the different airfare, not everyone riding on the same airplane pays the same price for the seat. It really depends on when you buy the ticket. And finally, some goods and services, say for example like buying a car, there can be some haggling or negotiation involved where the price may be lower for some customers. So to break it down, then there's basically three types of price discrimination, or common types of price discrimination. The first one is the one that you have to know for any testing purposes and for College Board testing purposes, and that is first degree or perfect price discrimination. And this essentially means that a firm could charge a different price to every single customer. So every customer that walks in the door can pay a different price, and of course they would be able to charge them their max willingness to pay. Now, for obvious reasons, this is very difficult to do because that means the customer would have to be willing to admit how much they're willing to pay and then actually pay that price. And you can imagine how this is somewhat of a theoretical concept because it's very difficult for a business to somehow charge every single customer a different price. So while it is the most theoretical of the three on the screen here, it is the one that you have to know for testing purposes. Now, I put the other two types of price discrimination on the slide here, just more FYI. Second degree price discrimination is when firms charge a different price for different quantities consumed. So this would be like your bulk purchases. Someone buys in bulk and they end up paying a lower price per unit than someone who just buys an individual unit. That'd be like a case of soda versus buying one can of soda or one bottle of soda at a convenience store. And then third degree price discrimination is when firms charge a different price to different groups of customers. This would be, again, charging different admission rates based on age, or it could be giving discounts to customers who have signed up for a customer loyalty program. So why do firms want to price discriminate? If they're able to charge different prices to different customers, they're able to take away all the consumer surplus in the market and transfer it into producer surplus, and of course, a better chance of increasing profit. So here's an image from the book where you have two different groups of customers, one willing to pay $550 for a seat on an airplane and another group of customers who are only willing to pay $150. So if the firm is able to charge two different prices to two different sets of customers, they are able to take away that consumer surplus and maximize profit. So the greater variety of prices that a monopoly can charge, the greater the ability to capture more of that consumer surplus and maximize profits, as you can see from the different graphs on this particular slide. So in order to do this, you should know that firms must have, one, they must have market power. They have to have the ability to control market prices, unlike what we saw in perfect competition. Two, they have to have the ability to identify customers' willingness to pay. And three, they have to be able to prevent resale between consumers. So one group of consumers who could buy something at a cheap price and then sell it to another customer for a lower price than what the monopoly would charge that second group of customers. And one more thing to really emphasize that you see on this slide is in the top right hand corner. It says here demand equals marginal revenue. When the monopoly or firm is able to perfectly price discriminate, the demand curve is no longer separate and above the marginal revenue curve. Marginal revenue equals demand because all consumers are paying a different price. And the last slide of this video here emphasizes that key point. The graph on the left on the slide shows a single price monopoly earning economic profit. You can see the single price that the monopoly charges, and the green area of the rectangle there is the profit of the monopoly, the distance between the one price it charges for all customers and the ATC. That difference is the profit. The graph on the right is a perfectly price discriminating monopoly. You can see that there is no one price indicated because each customer pays a different price. Okay, but the quantity is determined now by where the marginal cost equals marginal revenue, which is always the same, but that marginal revenue curve is now equal to the demand curve. So you can actually see that the quantity is increased when you compare the two monopolies, but every customer pays a different price, which is why when you compare the amount of profit between these two monopolies, the monopoly on the right, the perfectly price discriminating monopoly, will have a greater amount of profit. And again, this is the significance of price discrimination and why a firm would like to be able to perfectly price discriminate.